Good morning, ladies and gentlemen. Welcome to the introduction to Vector Capital PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. We'll notify you by email when these are ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Agam Jain, CEO of Vector Capital PLC. Good morning.
Good morning, everyone. Thank you for taking the time to attend. And my name is Agam Jain, and I'm the CEO of Vector Capital. And today I'll share where we are in our journey and how we got on since we listed. Thank you. So if I give you an overview of the business, Vector provides non-regulated loans to other businesses, which are secured against land and property in England and Wales. We're not a startup, so we've been going for 20 years. We're very well established and very profitable lender. We've got banking relationships with two wholesale banks, where we have 25 million in facilities. We have a progressive dividend policy and anticipated capital growth. A highly experienced management team, which I will take you through shortly, and a very effective credit and risk management model. We were admitted to AIM in December 29th recently, and we raised 3 million, all of which is being deployed to increase our lending capacity. So a short introduction to the board then. So it's myself. So I've been involved in the lending operations for over 20 years. I've got a background in business IT systems and team development. And I maintain all the key relationships with investors, banks, and some key brokers. John Pugsley is our finance director. He's been with us for about 11 to 12 years now, and he is a qualified chartered certified accountant, and he has a responsibility for the financial oversight of the business. We've got a heavyweight board. Robin Stevens, who's a senior chartered accountant, an ex-former head of capital markets at Crowe. So he's our chairman, and he provides sort of the go-to for senior accounting matters and guidance on running a public company. Ross Andrews, he's our senior NED. He's got very extensive commercial and corporate governance experience, which he brings to our board, as well as advice on operating as a public company and maintaining our governance standards. Neil is our Chief Operations Officer. He's responsible for the day-to-day running of the operations. He's got a lot of financial experience and operational experience on managing our platform and the day-to-day dealings with our customers, that's borrowers and brokers, and our relationships from drawing down from our bank facilities right up to the stage of credit vetting the loans that we do. He sits on our credit committee, and also for dealing with matters of defaults and recoveries. Here's a snapshot of the size of the business. We've got approximately 45 million in deployable capital, not all of which we can utilize, and I'll come to that in a minute. There's 63 live loans as of 31st December. What we mean by live loans is that in our business, we have loans that we issue, and then we have loans that get redeemed. And so at any point in time, there will be the net number of loans that are live. The loan book end of December was 36.4 million, and the shareholders' funds employed in the business are approximately 20 million. The average loan size then works out at 577,000, although that ranges from some of the larger loans, which may be 2.5 million, right down to maybe £100,000 loans. So our strategy for 2021 then is to see how far we can get up to increasing our loan book. Our medium-term target over the next 2 to 3 years is very ambitious. We want to become a £100 million loan book company in the next 2 to 3 years. There's a lot of work to get there, but we've got the roadmap to do it. The key method is to build up our relationships with brokers that introduce the type of business that we want to do. We're also always on the lookout to source increased debt facilities that we can deploy against certain types of loans. And I'll sort of come into more detail what I mean by land and new build as we go along. As always, we're always investing in training and skill development so that the team that we have can just manage more responsibility. We don't have any need to increase our headcount. So we can achieve our medium-term target without an increase in headcount. And we'll continue to make sure that we're at the top of our game in terms of risk management and credit assessment to keep our bad debt risks to an absolute minimum. So we're in a competitive market. As you'll know, you can get a home mortgage for 1.5% per annum, but that's not the end of the market that we're in. We're into the sector where it's people that are buying properties to develop. They'll be buying land and they might want to build from ground up, or they might be buying a built property that they'll want to refurbish and then convert to flats. And then the exit for all our borrowers is usually to refinance or sell on the property. Now, our cost of funds is quite expensive. It's 6.5%. But having said that, we're able to achieve 11 to 14% on what we can charge our customers. And so we can make a margin in between, which is still attractive, 4 to 5%. We've got the ability to increase the facilities with our wholesale banks as we go along, and we'll continue to do that. So where do our deals come from? At the moment, we're working with about 4 or 5 long-standing brokers that we've got good relationships with. So they know what our appetite is for the type of market segments that we want to serve. So these brokers would pre-assess to decide whether these loans would be suitable for us. They would submit these via our portal, and then we would then take the process forward, which I'll come to in the next slide. We're also members of the Association of Short-Term Lenders, which is the body that represents our segment of the lending industry. So we've got a very stringent loan appraisal process. So like I said, the brokers wouldn't submit something to us if they didn't think it had a chance of getting through. Once we receive the proposal on our portal, we'll run an AML check and a credit check via creditsafe.com. Creditsafe.com is similar to Equifax, and we access their database to go through the initial checks. The proposal would then be reviewed by our credit committee, which is a minimum of 2 to 3 directors. Once it's past that, we would issue a facility letter, and that means that we've decided that the risk is acceptable to us versus the profit potential. We will then pass that on to our firm of solicitors. who specialize in doing the due diligence. They will then do full legal due diligence and give us a red flag report to highlight any things that we should look at further. And if everything passes muster, we would then release funds to our solicitors, and the solicitors then would release those funds to the borrower solicitors. All our loans are always solicitor to solicitor. We never deal directly with the customer. So there's always a curtain between us and our borrower. Okay, so what do I mean by secured loans? So we would never lend to anybody just on the basis of simple documentation or a loan agreement or something. We always take land or property as security. And that security is always the first charge. So we might take some second charges as supplementary security, but the main loan has always got to be secured by a first legal charge. So that if things do go belly up, we're in control. We can put a receiver in, and we can look to sell the property to recover what's owed to us. We also keep an eye on our loan to value. We'll go up to 75% on certain types of security, but our average loan to value as at 31st December was 44.17%, which is particularly attractive. So that means that the borrower has got a lot of skin in the game, and the last thing that they want to do is to default with us. We'll also take a debenture over the borrowing company, because a lot of the borrowing companies are usually SPVs set up for a particular project. And we will take directors' personal guarantees so that everybody's really committed to the transaction. And it's not just our risk, they're fully risked. Okay, one of the strengths that we have is we've built our own very scalable and bespoke IT infrastructure. It's called LAMS, and it's got a lot of technical advantages. All our data, and in fact all of our business, is up on the cloud, which means that in a situation like 2020, where we all had to work from home, it didn't affect us. We didn't need to be in an office. All our team were able to log in from home and work as if they were in the office, because all of our documentation, transactional history, everything was on the cloud, and we could just access via a login. The other great thing about it is, because everything to do with our business is on the system, it's got complete audit trails for every transaction. And it gives us live data, so we don't have to wait till the end of the month to know what's going on. We can see it as it happens. Now, as a finance company and as a publicly listed company, we're heavily audited. So one of the great advantages, especially during 2020 and the lockdowns, was that our auditors could audit us from wherever they were working, usually from home, because we gave them an audit login, and they could see every transaction and drill down to all the details that they needed without having to physically attend our offices. Similarly, the two wholesale banks that we deal with also audit us every quarter, which means that, in effect, we have 9 audits during the year, 4 each from the two banks, and 1 from our auditors. So that's 9 audits. It's quite a heavy amount of auditing that we go through. But it's a dream for the auditors, because they can do it from home. The next slide, which I'll go to now, is a little bit more detail on our funding sources. So we have a facility of 10 million with Aldermore Bank, and a facility of 15 million from Shawbrook Bank. And that, with the shareholders' funds, aggregates to a 45 million capacity. Now, we have some conditions for borrowings from the banks. We can go to Aldermore. Once we've done a deal, we can go to Aldermore. If it meets certain criteria. And the criteria are they like to make sure it's a residential property, and they don't want to do land or development. So it's got to be a property that's already got a roof on and is weatherproof. And they'll allow us to, so if we've lent our borrower £1 million, we can draw down 80% of that, but capped at 600,000. So that means that in the end, we can get 600,000 from them against £1 million loan. So 400,000 would be our coming out of our liquidity. With Shawbrook, it's a bit more favorable. We can draw down 800,000 from it. Now, to give you an example then, so if we decided to do a £2 million loan to a borrower, we would have to use 1.2 million from our liquidity and draw down 800,000 from Shawbrook. So although we get a lot of proposals for larger loans, at the moment, in order to yield the bank facilities, we're tending to prefer smaller loans simply so that we can maximize the amount of drawings that we can do. As at 31st December, we had roughly 15 million drawn down from the banks. We'd like to be able to utilize their facility more, but a lot of the deals that we like doing are against land with planning permission, where we can charge the borrower 14%. And there's quite a high level of demand for that type of business. But then that all has to come out from our own liquidity. We can't use bank money for that. Okay, so I won't spend too much time on this, but our trading and profit loss figures are very attractive. We've put the 30th June to 2020 there. Our final audited figures for 2020 will be released in early April. And I'll go on to, and similarly with our balance sheet, we're showing a continuous balance sheet growth. And that's even after paying a very healthy dividend. Our balance sheet will continue to grow year on year. And so all our investors will be able to see capital growth as well as dividend payout. I won't spend too much time on the cash flow, but suffice to say that the cash flow is in our control. If we feel it's getting tight, all we have to do is reduce the amount of new lending that we do to control that. So 2020 was a robust full year performance. We increased the loan book from 33.6 to 36.4 million, increased the number of live loans there. And because of revaluations of properties that had been developed, our LTV also fell to 44%. During 2020, we faced a new circumstance like everybody else. There was the lockdown in March, and like everybody else, we had no idea of what was going to happen. So we were prudent and took a pause during April, May, and June. And then we decided that our segment of the market had not been badly affected, and we decided to recommence. We had to, like everybody else in the interest, offer interest payment holidays to a few of our customers, all of which have recommenced their payments again. In the end, we did 3.7 million of new lending during the second half of 2020. As a result of which our loan book grew by 8%. So a bit on dividend policy then. The year 2019, we paid 699,000 in dividends. We paid an interim of 400,000 for 2020, and there's going to be a healthy dividend coming in April 2021. Which has been forecast in the research paper done by our brokers. And let me just go to the next slide. Here's a few snapshots of the type of projects that we've financed. I won't, go into just to them, but I think you'll get an idea. There's quite a few attractive projects that we financed up and down the country. And so in summary then, what would investors be getting from us? They're getting a very strong track record in commercial lending, built up over 20 years, a very experienced management team with many decades of industry experience. We're known in the market, and we've got a good ecosystem of wholesale banks, brokers, RICS surveyors, and advisors. One of the chief reasons why a lot of brokers like to deal with us is that we give them instant decisions same day, and we're flexible, and we try to please and get a deal done. We've got a particularly powerful cloud-based IT system that's fully scalable, and we can grow the business on without increasing our headcounts. And we've actually got as I said in the beginning, we're not a startup, and we've got a very attractive track record of profit and cash generation, and what we want to be able to share with all our investors is a progressive dividend policy where we'll pay a healthy dividend and show capital growth. So really, I think that's my presentation, and I'll be happy to get on to questions and answers shortly. Thank you.
Agam, thank you very much for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand side of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can understand your views and expectations. Agam, we have had several pre-submitted questions from investors, and perhaps I could start off the Q&A session with those, if you don't mind.
Yes, sir.
Great. The first question we had is, what is your prospective dividend yield, and how does this compare to your peer group?
Okay, so we're going to be, I can't commit to it myself now, but the brokers have forecast a 1.4p dividend, the final year dividend for 2020. And if we add that to the interim, then that gives a 2.4p dividend for 2020, which I'm being told is over 6%. And from what I know in the market, I think that's an extremely attractive dividend compared to a lot of companies that are on AIM.
Thank you very much indeed. The next pre-submitted question we have here is, what demand are you currently seeing for your loans?
Okay, so let me answer this in two parts. There's a lot of demand for the type of loans that we want to do. For example, I had a proposal for a £4 million loan on Monday. But as I said when I was explaining our funding sources, we're limited to being able to draw down sort of say 800,000 from the bank on a compliant deal. Now, so why did I have to turn that deal away? Because it would have required 3.2 million from our liquidity, which meant that we wouldn't really be able to do a lot of other business. So at the moment, we're tending to do sub £2 million loans. But as we manage to break out of this straitjacket over the coming months, we by renegotiating our facilities with the banks or finding an alternative debt facility, we'll be able to sort of take advantage. But at the moment, the demand is there, but we're not in a position to meet all of it.
Fantastic, thank you. We have had, obviously, as you can see, a number of questions submitted by investors during today's presentation. Perhaps I could hand back to you, Agam, just where it's appropriate for you to do so, just to read out the question and your answer, please. That'd be great.
Yes, okay. So I've got a question here from a George S. How big is the team? Okay, so on the payroll, you'll be pleased to know we've only got 9 people. Having said that, I like to consider part of I used the word ecosystem before, is we've got about 6 or 7 long-term brokers with their teams. One of the brokers has got like 13 advisors, for example. The solicitors that we deal with have got 3 people that permanently work 99% on our deals. So yes, we're not a company with thousands of people on our overheads. We're sort of agile and I would like to say slim. Okay, so I hope that answers the question for George. And I've got a question here from John A. Agam, you said publicly that you are looking to raise capital again, potentially next year, to continue the growth of the loan book. My question is, can you give a public commitment that potential new shareholders, particularly small shareholders, will be given a fair opportunity to participate in any future equity raise, not just institutional investors? Okay, right, look, it is our intention as part of our roadmap to come back to the market one day. We are not in a position to sort of talk about when. It'll just, because I think our focus at the moment is to show you some development and growth and pay some dividends to our existing shareholders. But yes, certainly we'll give a fair opportunity for all to participate in any future equity raise and not just institutional. Right. I hope that's an answer. The Simon C asks, what impact do you think COVID will have on your loan book, and what differentiates you from other providers? Okay, so look, we live in a world with other people, and I can't say that COVID's not going to affect us. The main effect it's going to have on us is that we've got various types of borrowers, and some of them we had to give a payment holiday to during the first lockdown. And during this lockdown, there's a few more that have asked for some forbearance, and we've agreed to give them interest payment holidays. Now, the effect of that is that it means that we're not collecting the interest on a monthly basis for some of these borrowers, but the interest is still accruing, okay? And because the loan to value ratios are quite sort of prudent, we're in a position that it'll just increase the amount of the loan because we'll roll up that interest into the loan. And then when they come to redeem, we will be able to recover it. So it won't affect our profit and loss figures, but it will just defer the time when we'll actually receive the cash. And this will also impact the timing of the redemption. So people that might have wanted to refinance and exit from us at a particular time, we can say that that time will now increase by another 6 months or a year before they can exit from us, which is good in a way for us that we have people paying higher rates of interest, being more sticky, i.e. staying longer with us. Because as I mentioned earlier, most of these people exit by refinancing with cheaper high street banks when they're in a position to do so. So that's the impact of COVID. So the conclusion is that it won't affect our profit and loss, but it'll defer our cash receivables. There's another question here from John A. How much improvement do you expect in net margin now that you are a public company and have fresh capital? This was something you mentioned in the admission document, which would improve NIM. Now you're on the market, as you should be able to negotiate with the banks. Okay, this is a fair question. And this is something that is our objective, to try and increase our net margins. And how will we do that? Is it, instead of paying this hefty 6.5% that we're paying, if we could get better rates, okay, and have less constraints on the type of deals that we're allowed to draw down from. Now, one of the things that as a management team we're doing to try and achieve this is we're starting negotiations with other banks. And I can't predict the outcome right now, but I got 2 meetings lined up with 2 new banks next week, and I'll report back to the investors during the course of the year on how we get on, and see if we can get better interest rates and less constraints and bigger facilities from alternative banks. So this will be an ongoing exercise. I've got another. There's a question here from John M. You mentioned you can charge X% for lending on greenfield site. That's a fantastic return on capital. Is there not a case to raise more capital through equity to go after that market? There certainly is. And my answer to that is, we've only just got admitted 29th December, so we're barely 2 months into it. And the time to come back to the market is after we've paid a few rounds of dividend and made all our investors happy. And I think the timing of that, we'll be discussing with our advisors and when that can be. But yes, it's on the roadmap. With record low, this is a question from Tom G. With record low interest rates at the moment, how significant of a risk do you consider competitors offering similar products at lower interests? Yes, there's a lot of competition out there, and there's a lot of people a lot cheaper than us. But as with everything, we've just got to be better. And so one of the things that I'd said in our objective is just to keep improving our team performance and skill development, and make sure that we get our share of the market, based on our model. Last thing we want to do is try to compete on interest rates, simply, and we don't need to do that for the next 2 to 3 years. I think we've got enough work to do. So yes, it is if we wanted to get into being £1 billion company or a £500 million company, then that would be a serious issue. But I think to our 100 million loan book, I think we can carry on with the model that we've got. Okay, John M. I think he's sorry. So the next question really is Anthony M. What was the period to get to a 100 million loan book? All right, look, there's a dream and there's an ambition. I'd like to say we could get to that within 2 to 3 years, but a lot of it will also do with how successful we are in getting our debt facility improved. So if we're successful with one of the other banks that we're talking to, and we can get facilities from them, we could get there faster. But if we were managed to do it in 2.5 years from now, I'd think that was a satisfactory performance. All right, Mark T. How long do you think bank appetite to lend in your space will be limited? Some alternative lenders are suggesting 1 to 2% wider margins or lower LTVs. Is that your experience, and how long will it last? Okay, I haven't quite understood that question, so let me try and read that again. How long do you think bank appetite to lend in your space will be limited? Some alternative lenders are suggesting 1 to 2% wider margins on lower LTV. Okay, the 2 banks that I'm dealing with, Shawbrook and Aldermore, they're quite sort of strict, and we'll be up for renegotiations with them in the summer this year, and then I'll see if they'll ease their view on matters. But because I've started conversations with other banks, I'll be able to answer that question later on. At the moment, I don't know. Yeah. John A, do you have a net promoter score? How many of your clients come back for repeat business? Okay, this is a very good question. And I think I haven't got a score, but I think whatever it would score very highly, because so much of our loan book is repeat borrowers, and all our brokers stick with us over many, many years. So we must be doing something right. Mark T, just asking what current lenders are doing. Our feedback is, as lender banks are less active, so competition, so OIN your loans. So I'm not sure what you meant there, Mark. Our feedback is lender banks are less active. What I have noticed and what I can comment is that when people try to refinance away from Vector, i.e. say they've refurbished their property and they've converted the flats and then they've rented it out. So that's the stage they can go back to high street banks and refinance at much lower rates. And they do eventually manage to do that. But where they think they can get that done in 2 to 3 months, I'm finding is taking them 6 months plus, which is pretty pathetic. I don't know why. Either the high street lenders are just more cautious, or because of their staff working from home and their decision making processes, it's just taking a lot longer for them. Okay, so Mark T again. I was asking about competition on lending. So I think I've covered that in quite a lot of detail. Yes, there is a lot of competition for standard lending, that is lending against residential property, but it's less competitive when you get to refurbishments and developments, and a lot less competitive when you're doing land. Okay, I think that was the last note. There's another one. John A again, you say that you want to continue loan growth. Are you looking to recruit more brokers, and or have your existing brokers got the deals if you can finance them? Okay, so where we are at the moment, we've probably got about 6 active brokers that we are maintaining relationships with. And it's probably just enough for the size of business that we're doing at the moment. But to get to our 100 million, we'll probably have to double that amount to get up to about 12 to 15 active brokers. Now, that's not as hard as it sounds, because we've got a database of about 700 brokers that we keep in touch with. But we keep in touch very gently with them, because we don't want to activate too many of them, because we don't always have the capacity then to be able to do the business. So what we're doing is gradually increasing that, and I'd be quite happy if by the summer we had 10 active brokers. That would be good enough for us, yeah? And then maybe we could get to a situation of about 15 to 20 next year, and that would be enough for us to hit our 100 million. We could get enough introductions from them to do the amount of business that we need to do. Who are your main competitors, and do you see P2P as competitors? No, I don't see P2P as competitors, although they will try and do, they'll get a share of the market, but our model is totally different. Our model is to be the prime lender and not get involved in having lots of lenders against a particular deal. So our model is not going to change. Our main lenders, competitors, are people like West One, Shawbrook themselves, Aldermore themselves. And in fact, if you wanted a list of them, you can find them on the astl.com website, which is our industry association. So a lot of them are slightly bigger than us, but they're in the bridging and development space. That was a question from Anthony M. Is any other questions? I can't see any more now.
I think you've been very kind. You've gone through every single one. Thank you. Again, that is absolutely fantastic. And if any further questions do come through from investors today, they will be reviewed by the company, and we'll publish those answered on the Investor Meet Company platform. Again, perhaps I could just ask you for a final few words just to wrap up before we redirect investors for a little bit of feedback, please.
Okay. I'm very pleased that there are quite a few of you joined this presentation. And hopefully I've given you sort of quite intimate knowledge of our business model and how we work and what our ambitions are. And that, you'll stick with us on the journey. And when we come back to the market, you'll have an appetite. And we want to concentrate on, giving a great performance. That's it, really. Thank you very much.
Fantastic. Thank you, Ag, and thank you for updating investors today. Could I please ask investors not to close the session, as you will now automatically be redirected for the opportunity to provide your feedback. If you've accessed this meeting from our website, the feedback page will appear in front of you. If you've accessed the meeting via the link sent to you in the email, you'll be simply asked to log back in and submit your feedback. Do please take a couple of seconds to do so. It'd be much appreciated by the company. On behalf of Vector Capital PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good morning.